All right, guys. Hey, we're back for another episode here of Ask a CPA. I'm here with my good buddy Brett Phillips from Phillips and Shiflett. How are you doing, Brett?
I am doing fantastic, Russell. Still recovering from our fishing trip. I
Yeah,
don't know if we've talked about that on here. We went down to Venice, the second nicest Venice,
second nicest
Louisiana,
Venice, that's for sure.
and went redfish fishing and caught some monsters. Man, that was a blast. That was so much fun.
Yeah, absolutely. Venice, Louisiana. It's south of New Orleans. If y'all aren't familiar with the second nicest Venice in the world, neat little fact we saw while we were getting maps to the marina. We saw that there was a little Google pig that right next to the marina, it was like the southernmost tip of Louisiana that you can drive to, right? It was right next to this place. So that was kind of cool.
Yeah.
If you want to go down there, ask for Mason. He's a good golfer and a great fisherman.
Yeah,
You know,
Mason was the man. He was awesome. He put us
yeah.
right on the fish. That was great. Where was the place we stayed? It was Venice.
Venice Fishing Lodge is what it's called. Yeah,
Venice Fishing
just Venice
Lodge. Yeah,
Fishing
it
Lodge.
was
Yeah,
great.
it was a really good time. They have a great lodge there. It's a great marina. Some of the best fishing. I've done a lot of this like redfish bay fishing before, and all along several spots here in the coast of Texas. And this was the fish were way hot. I don't know if it was the time of year. I don't know if it was Mason. If it was just the place. It's always that hot, but. I think we caught we limited out in like an hour or something.
Yeah, it was
And then
crazy.
after we caught like over 100 fish in the boat, we were finally just like, I guess we'll just like go in and have a
Yeah,
beer.
I still have like a mark on my finger where I had a blister from catching so many fish,
Yeah.
fighting these fish for like hours. It was so much fun.
It was a ton of fun. Ton of fun. And, redfish are great fish to eat, to catch, to eat, to all of that.
Yeah, we had some last night. It was amazing. Yeah, it was
Yeah.
great. Great fish.
The
Although
black and
I almost
redfish.
choked on a scale,
Oh, no.
but it was good. It was
There you
good.
go. There you
Kid,
go.
kids ate it up, and they sent us home with like a little Cajun seasoning, which was awesome. Man, we just doused it in that. It was so good, and a little butter.
Yeah.
Yeah, that redfish is amazing.
Yeah, it's good stuff. It's good stuff. Highly recommend it for any of our listeners out there that if you like to fish, or even if fishing isn't like your favorite thing, down there in Venice, it's not really fishing; it's just catching.
Right.
I always like to say I'm not the biggest fan of fishing. I like it okay, but I really like to catch. And so if you like to catch fish, that's the spot to go.
Yeah, they put you right on him. It's pretty amazing. Yeah, he was a
Absolutely.
cool guy.
Well, today we've got rapid fire. So we've
Rapid
got
fire.
a
Let's
big list of
go.
questions. We've actually only read a few of these, and so this is going to be interesting. We're gonna see just how much accounting knowledge we can spring off the top of our heads here a little bit.
Yep. And we're gonna try to make it quick. I mean, we're not giving long answers, giving quick, under 30-second answers. We got 25 questions. We're gonna fly through these. We're just gonna go back and forth, and I'm gonna make fun of you if you say something
Man,
something wrong.
no time to chat GPT these things. So
That's right. All right, you want to start or you want me to start?
yeah, I'll take it. I'll take it. I'd rather you answer the first question.
All right.
All right. So, should I pay off my student loans or invest in retirement first?
Great questions. I would, if you have an employer match, I would do the employer match up to whatever percentage they're willing to match, whether 3-4%, because that's kind of free money. You want to take that; it's included in your comp, and then the rest of it I would dump into paying off student loans and get out of debt as quickly as possible.
There you go. Free
All
money
right.
and then pay off the debt.
Yep, you got it. Number two, is it ever okay to have a credit card for emergency or points?
Yeah, so my early college days of listening to Dave Ramsey would probably argue this point pretty fervently, and but I would say we're you're good. You're good. If you've got reasonable credit, you're paying it off. If you're getting some points, you're racking up some points. That's great. So we've traveled together with the wives, and I love being able to do that. And it's an easy yes if someone's like, hey, let's take a weekend trip with the wife because if you have airline points, you don't have to pay for the airline ticket, and
Right.
that sort of thing is great. Now I know all of the math stuff about you can get cash back and all this other stuff, but if you got cash back, you wouldn't travel with the wife with the cash back. But if you've got the airline points, you will. So if you want to, It's totally fine as long as your financial house is in order in the other areas.
Pay it off.
There you go. All right. So how do I get out of debt when I'm living paycheck to paycheck?
This is a hard one. I mean, first of all, you have to live below your means. Don't keep increasing your lifestyle as your income increases. Keep your lifestyle flat. Continue to increase your income. Work harder, grind, get a side job, drive for Uber. Do whatever you have to do to provide for your family. So yeah, I mean, the first few years when I started my firm, and we worked our butts off. I mean, 15 hours a day and just grinded. Anybody that was willing to pay us, we would do the work. I mean, we would just grind. So grind hard, and get out of that paycheck to paycheck. Start saving some money, and yeah, I mean, it's a grind, but you gotta get out of it for sure.
Yeah. Yeah.
All right, next question. Should I use my savings to pay off my car loan? What do you think, Russell?
Man, it depends on the interest rate. So right now, yeah, I'd love to have an emergency fund. The economy is a little bit shaky right now, I feel like, in a lot of areas. And so, if you're in a job, if you're a nurse or something like that, then a teacher, you got super stable jobs, then I'm probably a little bit more okay with that. If you're in a different industry that may be hit or affected by some of the tariff stuff that's going on, or maybe you're in a manufacturing type of facility or job where, whether this tax bill with bonus depreciation gets passed or not could really affect that business, I'm probably not taking the risk and I'm holding on to the cash. But if you're in a super stable job and you got a high interest rate on the car note, a lot of interest rates today, 8.5% on a car note, that sort of thing. If you're looking at something like that, then I'm paying it off. But I'm making sure again that I've got some security. So I'm not using all my savings for that, right? So I'm, you still want to have some emergency fund left. But if you can have some emergency fund left, you got a stable job, I'm getting rid of that high interest rate car note. There's no doubt.
Right.
No doubt.
Pay it off.
Well, that leads me to the next question here. How much should I have in an emergency fund?
Yeah, easy question. 3 to 6 months of your household operating expenses. Keep that in cash, put it in a high yield savings account. And I don't know, I'm making 4.5% maybe. Honestly, in cash right now, so not bad. But yeah, stick that in a high yield savings account. You'd be good to go. So next question, number 6, is it smarter to rent or buy a house in today's market?
Man. So I'll tell you what the math says, and the math says that if you rent, you'll have more disposable income. You use that disposable income, invest in the market. You're going to do better long term than owning a house, and you may not even have to mow your own yard, right? If you live in a condo, townhome, that sort of thing. So
I like mowing the yard.
There you go. I've seen you mow the yard, right? In your hat, and you got your "My Tractor's Sexy" sticker on the tractor, on the John Deere. That's good.
That's right.
But not everybody can pull that look off like you can, Brett. So, but nobody ever does that, right? That's the problem, right? Is that the math says it's more disposable income if you rent, you invest the difference, you come out ahead, that sort of thing. Nobody ever does that. If you own your own house, one, you have kind of the benefits of ownership, which, you get to do whatever you want. There's no permission structure where you have to ask a landlord, all of that stuff. There's some headaches with it. There's some mowing the grass with it, that sort of thing. But you also have kind of a forced savings. So every time you pay off, make a payment or a rent, like you would rent payment or mortgage payment, part of that's going to principal. It's kind of a forced savings account. And so that's where you end up doing better. Over the last 6-7 years, housing prices, especially here where we're at in the DFW Metroplex and a lot of other places across the country, housing has exploded in value. And so if you owned, you definitely came out ahead owning, even in the stock market, going up, reaching all-time highs, all that stuff over the last 6 or 7 years. You've definitely done better owning a house than you have renting. But again, the math doesn't say that, but we all know it's not just about math. Finance isn't just about math. It's about the emotional concept too. And so I like owning over renting.
Yeah, I do too.
Yeah.
It's a good long-term play.
Well, how much house can I really afford? So if you are going to buy, how much should you buy?
Yeah, I guess it depends. Everybody's situation is different. It depends on, you got to look at all of your outstanding liabilities. So if you have student loans, if you have credit card debt, if you have any other personal debt, personal outstanding liabilities, you want to make sure those are paid off or paid down. And you probably want to keep your total household payment under 30-40% of your total take home pay. So yeah, look at what your total income is, what your total take home pay after taxes and everything, and then look at what your kind of budget out what your current expenses are, whether it's if you eat out a lot, or if everybody's situation's different. If you have medical expenses, if you're you have to take all these expenses into account. So there's so many calculators. Go out on like a Nerd Wallet, or just Google how much house can I afford. There's all kinds of calculators. They'll kind of walk you through whatever your take home pay is, and then they'll calculate and kind of back into what you can actually afford. You have to obviously take into account mortgage interest, property taxes, PMI if you have to pay PMI on the property as well. So yeah, you got to kind of take everything into account. Everybody's situation is different, but good rule of thumb is probably 30-40%, somewhere in between there, of your take home pay for your total housing cost.
Yeah. And if you're renting, that, making sure you calculate that insurance and taxes in there is key, right? It's not just about the payment. You have that insurance and taxes too.
Yep. All right, Russell, here we go. Should I take out a 15 or 30-year mortgage? What do you think?
Man, so, this is where calling your CPA. I know this is something that I think my clients should call me about. I hope they call me about. I bet you do too, is where we can add a little bit of value. So clients maybe that don't love Excel spreadsheets, right? So give us a shout and we can help you calculate this, right? So what's the key here is that you're going to get generally a lower mortgage rate for the 15-year versus 30 years. So you're going to have a lower rate, but a higher generally payment, right? So your lower rate, but higher payment, and kind of where those kind of balance out. So you talked about kind of 30 to 40% mark, and looking kind of holistically at where your household budget is, those kinds of things. This is something that, having a good qualified CPA in your corner that can help, kind of talk you through this pretty quickly, right? This is kind of the math that we can generally do pretty fast, and kind of help you think through all these points. If you can swing the lower rate in the 15-year mortgage, and that's fantastic. I think, you're going to build up equity faster. You're eventually going to have your house paid off, hopefully, that sort of thing. Ideally, by the time you get to 60, 65, you're going to want that house paid off as you're on fixed income, those kinds of things. And so you don't want to end up in that kind of house poor category where you have a whole bunch of equity in the house, but not enough retirement, that sort of thing. So you got to make sure that there's enough money to do that 15-year mortgage, there's enough money left over to do those other things that are super important as well. But if you can swing that 15-year, you're going to get a lower rate, build up the equity faster. It's going to be better.
Right. Yep. I love 15-year mortgage. I wish my first property was on a 15-year mortgage, man.
Man, and your first one, man, that really helps build up that equity fast when you're young.
It does. Yeah, it's huge. But yeah, now I'm on a 30-year.
Now you're on a 30-year. Man.
Yeah,
it's got a big, beautiful house, though, folks.
We just keep rolling. You keep rolling that equity. Yeah.
There you go. Well, should I quit my job to start a business even if I'm not debt free?
No. Don't do that. Don't do that. Bad idea. How are you gonna pay your debt if you don't have a job? No, don't start a business if you're not financially secure. Start a side business. Start a side hustle.
Oh, yeah.
And if that can eventually replace your day job, then great. Then it's time to quit. But do not quit thinking that you are going to kick off this great business without a plan in place. You need to already have a side income, a business that's generating revenue, that's reliable before you quit your day job. I mean, no, absolutely not. Do not do that. No.
So John Acuff is an author, speaker guy that's got a couple of books out, Quitter and Start. They're good kind of marketing terms, talks about this a lot, like how to blend this kind of like, how do I think about starting a business without leaving my full-time job. You got to make sure that you're not pulling, clients and services away from your full-time gig, right? Like you work for another business, and you want to make sure you're not violating any non-solicitation agreements and those kinds of things. But if you can swing that and kind of do this other thing on the side, or just think about it a different way, right? So instead of starting the restaurant, maybe you start a food truck on the weekends and do catering and things like that, right? So build up this fan base and following, little things like that, different ways to think about it. But those are two good books that really kind of help you think through that process, and worth the read if you're looking to do something like this.
Yeah, I've read both those books. They're great.
Oh yeah. Yeah.
All right, Russell, here we go. What are we on? Question number 10. How do I ask for a raise or switch careers without taking a financial hit?
Whew, man. So if you work for me, you can stop listening for a moment. But so, if you're going to go in and ask for a raise, right, you're going to need a reason for it, right? And so every industry has kind of some rules of thumb that you can kind of go by. The kind of accounting CPA industry is no different, but, kind of figure out what those are, right? And they're kind of metrics, so percentages of revenue that people look at that should go towards things like overhead costs, and other things that should go towards like personnel costs, that sort of stuff, right? So you can also know like how much value you're creating. Like nobody has a problem paying you an unlimited amount of money. Like for real. Like when you say that, it's not a joke, right?
Yeah.
An unlimited amount of money you could make working for someone else. You just have to provide a lot more value than what you cost, right? So my general rule of thumb is when I look at clients, like I want to try to provide 4x 5x value what I'm charging them, right? And so I'm kind of thinking about that kind of value proposition in that way. And as an employee, like that's a great way to think about it too. Like like owning your own business isn't for everybody. It's not even the most financially successful way to live your life, that's for sure, right? We both know people that have made buku's money, probably more than we're going to make, working for somebody else, right?
Absolutely.
It does kind of make you rethink some life decisions you made in the past, but they're going to do great, right? And so it's one of those things that but you can still think about what you as an employer are doing in the same way, kind of this entrepreneuristic kind of way, and you're going to make yourself completely invaluable. And somebody who's invaluable comes to me and says, hey, I've created $700,000-800,000 worth of value. I think I should be paid $200,000, $300,000. I'm going to say like yes to that all day, right? Because I don't want to lose that, especially if it's something, if they left, I'm going to lose that additional value add that they've created, right? You're going to say yes to that every day because you can do the math, right? But you do the math first and then come to your boss with the math. And don't just say, look, I feel like I should make more. That's great that you feel that way, but business doesn't always care about your feelings as much, right? And so come to them with some math and some real hard facts about why you should make some more. Part of that's going to be your leadership, your skills, all of that. But it has to, at some point, you have to show how that's converting to like real dollars for the business, right? Yeah. So just because you have a master's degree doesn't mean you should make more. It's great you have a master's degree. How's that going to convert into real dollars coming in the door?
Right. Show your value. Go above and beyond. Outwork everybody. Out hustle everybody. Bring that value. Be somebody that your employer cannot live without. Be that unreplaceable person, and then you have leverage to go in and renegotiate. You don't want to go to your employer and say, my husband lost his job or my spouse lost their job. I need more money.
Yeah.
I'm sorry, that's not a good reason for us to pay you more. You need to provide more value. And I think most employers, if you came to them and said, hey, I need to make more money, what can I do? They will lay that out for you. Here's what you need to do.
Absolutely.
You need to do X, Y, and Z. So go to your manager and tell them what your goals are and, request a one-on-one and ask them, what do I need to do to get to where I want to be?
Yeah. Show some initiative goes a long way.
Yeah.
For sure.
Yeah.
For sure. Well, so if you've never invested before, how do you start investing? So what would you say to somebody who's asking that?
Yeah, I'd say easy. Open a brokerage account, go to fidelity.com, Charles Schwab, Merrill Lynch,
Vanguard's another good one.
Which one?
Vanguard, they're like the low cost,
Vanguard,
low,
sure.
that sort of folks, right?
Yeah, any of these online brokerage houses, you can open an account online. and then just set up reoccurring investments. It could
There you
be
go.
super little. It could be $25 a month. It could be $50 a month, or you know, any amount, and then just set it. I would start with like a target fund and just say, I want to retire, in 40 years or 30 years, 20 years, whatever your target date is, and just invest in that target fund, set it, forget it, don't even think about it, and then just start to build that up. And you could even roll your emergency fund into that brokerage account and put it into cash. And typically the brokerages will pay whatever market is. So I think I use Fidelity. I'm getting 4.5% on cash, and then I have a fixed amount that I roll into each. I have like an index fund that I put a certain amount in each week, and it buys in weekly. So I'm kind of cost averaging, whatever the market is. I'm buying on the dips, and I'm buying up as well, but it's kind of it'll kind of smooth out. I'm not trying to time the market. I'm like, I just want to get in the market. So I have it set to buy in each Monday and at a certain amount, and that's how you get in. And you just start accumulating that. Start to follow. Like if you think you want to buy some individual stocks as well, I think you want to keep that as a smaller percentage of your overall portfolio, maybe 10, 15, 20% at max. And start to buy up some individual stocks. Like when the market was down a few weeks ago, I picked up some like Tesla stocks, some Microsoft, all the tech stocks took a bit of a dip. So when that happened, I bought up a few of those. So just kind of start following the market and looking for opportunities whenever things are trending down and people are, stocks are dropping in price. That's the time to start buying up, and then, don't sell. Just hold on to them as long as you can. As long as you can feel that pain, hold on to those stocks, and hopefully, if you believe in the future of those companies, they'll last a long time, and you'll be good to go.
There you go. There you go.
Yeah. Dive in. So which number was that, Russell? That was
11. We're on 12.
that was 11. So 12. So Roth IRA versus traditional IRA. Which one is better, Russell? What do you think? This is number 12.
Yeah, so I'll tell you the math generally works out to go Roth IRA. It's a little bit more painful because you got to pay the tax ahead of time, right? So nobody really wants to pay tax ahead of time. Like who wants to prepay tax? I want to delay tax as long as possible. In this case, though, it becomes tax-free when you pull it out, plus the contributions you can pull out at any time. So whatever you've put in, you can pull out anytime, penalty-free, which is another big benefit. So especially if you're going to retire before 59 and a half, where you can't pull out that growth, then it allows you some money that you can pull out, before you reach that 59 and a half line in the sands. So that's great. Traditional IRA is better if you're a really high income earner. You have some Roth limitations anyway. So there's some backdoor Roth, some different things that you can do in order to get money into a Roth, but there's generally some limitations. And if you're in a high income bracket, getting a tax deduction at 37%, whenever in retirement your tax rate's going to be 22%, right? That's a better rate play, right? So I'm gonna take a 15% rate play all day, and then maybe if my income dips, start doing some Roth conversions at that point. So rule of thumb, Roth is going to be better. For some nuance, some small nuance here, for real, talk to your financial advisor, your CPA, talk to some people who can do the math for you on this thing if you're not really familiar. But for some small nuance, it is really high income. You're gonna, top tax bracket income. You're gonna want to put that into your traditional IRA and save the taxes up front. If you're in a lower income though, if you're in the 22-24% tax bracket, go ahead and invest in the Roth.
Yeah, I think if you qualify for a Roth, do the Roth.
Yeah. There you go.
If you're young, 100% do the Roth, because the earnings on that Roth are going to be tax free as well, which
that compounding is massive when you're young. If you've got 15, 20 years to go and you can still contribute to a Roth just because of the income limitations, Roth's going to be amazing.
Yeah, Roth
all the way every day. Yeah. So what's the best way to talk to my spouse about money when we don't agree?
Oh, I was hoping you'd get this question. Over text.
Yeah, over text, definitely emojis for sure.
When I know my wife and I were putting in a pool right now in our house, and we're going back and forth, and there's certain things that I want, there's certain things that she wants. We've talked about it, we've argued about it. We know where each other stand on this topic, and now it's just text. It's all text. So if you are in that same situation and your wife or your spouse or are in conflict on something, I think if you can take the emotions out of it and just talk via email or text or written, I think that makes it a little bit easier. It kind of takes the emotion out, and you can read over what they're thinking and kind of
Yeah.
respond accordingly.
Run that response to ChatGPT too, right? Like make sure that your tone's right.
Yeah.
Let AI help your marriage.
That's right. That's right. And yeah, it can be difficult if you're not both rowing in the same direction, and that's important. I mean, this is the person you're going to be with the rest of your life, hopefully. So you want to make sure that you're both on the same page, and that if you're going in the same direction, you have the same goals. Hopefully, you've talked about these things before you got married.
Uh-huh.
But yeah, I'd say whenever my wife and I have conflicting opinions on something, we don't talk about it in person. We talk about it over text. I think it just leads to additional arguments. So that's my opinion. You got any opinions on this, Russell?
Yeah, no, so we just don't disagree, right? So that's the better way.
That must be nice.
No. No, I like the text thing, right? And it's good, that you can write it out. You can be at work, you can be at a place where you can have kind of this kind of slower response time, right? It's not just the immediate emotional, oh, like you feel robbed or hurt or injured, so I'm gonna lash out, that sort of thing.
Yeah.
Great book on this, leadership and self-deception. It's kind of like a leadership book, but man, it's fantastic for your marriage too, where you kind of learn about this concept of being in the box, right? So as soon as
Yeah.
somebody says something and you feel injured or whatever, then you go into the box, and then this idea of like victims victimize, right? It's like you feel victimized, so you feel like a victim, so you like lash out and try to victimize someone else,
Oh
and that
wow.
ends up
Okay.
being your
What was the
wife.
name of this book?
Leadership and self-deception, man. So this is a great one. I read this book only because I looked up a business books you should read, and they go, well, leadership and self-deception would be number one on the list, but surely everyone who's reading this list has read this book. And I was like, well, I haven't read this book. I better
I've
I
read
better get
hundreds of
on
business
this.
books.
And man, it's a good leadership book. It's great for W employees, but also it's one that you can kind of take home and be like, wow, and once you read it, it kind of like opens your eyes to some of these things that you do, and you're
Yeah.
like, wow, that wasn't good. I should be better than that, that sort of thing. So if you've read any of the Patrick Lencioni books or anything like that, like it uses kind of this kind of built out analogy to kind of like storytelling or parable to tell like kind of this kind of main truth, and so it's like a super easy read. Like you can read it in a
Yeah.
weekend, right? It's a 4-hour read, the whole thing, kind of thing. So
Okay.
it's good.
Cool.
It's
I'll read
good.
it this weekend.
Yeah, yeah.
All right, next question. Do I have to pay my taxes if I work under the table
Oh,
or get paid in cash?
absolutely not. Nobody knows. I keep it a secret. No, don't do that. 100% don't do that. The ruling from the IRS, right, here's the tax code ruling, is that all income that you receive is taxable unless it's explicitly exempted in the tax code. So what that means is that there's a very short list of money that is not taxable, and unless it's specifically listed, so things like municipal bond interest, right? That's tax exempt, right? So there's some things that are explicitly listed out that say, hey, you don't have to pay tax on this. If you receive money, doesn't matter if it's services, doesn't really matter if it's a garage sale. All of this money is supposed to be taxed, right? So you sell something and or do something, or somebody pays you for some service or anything that you've provided for value, it is supposed to be taxable. Now, here's another kicker: is that even if they don't pay you in cash, so even if you like barter services, you're still supposed to pay
Right.
taxes on the fair market value of that, right? So look, you're supposed to pay taxes, right? So if you receive value, whether it's cash or any other kind of remuneration, you're supposed to pay taxes on that. So there are ways to do that, right? So if you do receive money under the table, or you receive not under the table, if you receive money for services that you provide, right, that opens up an amazing door, right? Because now you're self-employed, right? So now the best tax deductions in the tax code happen to self-employed people and self-employed business owners. And so you're now a business owner. So this unlocks a lot of tax saving strategies and ways that your CPA or financial advisor can help you out. So be sure to talk to them if you have this kind of situation. But absolutely, you've got to pay taxes if you get paid in cash or under the table. So can I write off my home office if I have a full-time job and freelance on the side? Well, it's just a side gig. So can you still write it off?
Yeah, so if you're self-employed and use a portion of your house for your side hustle business, yeah, you can still deduct your home office expense as long as it's that portion of income. So you don't want to overstate the amount of expense related to your home office expense. But yeah, if it's a dedicated home office expense is being used for your business, it's ordinary and necessary in the course of business, then yes, yeah, of course you can still deduct a home office expense. And a lot of people think, by deducting a home office expense, it's going to raise this red flag and you're immediately going to get an IRS agent knocking on your door saying you took a home office you took a home office deduction, you're going to jail, I'm going to audit you. That is not the case. We take a home office deduction on every self-employed person that we do tax work for. I mean, there's two different methods. You can take a simplified method, which just takes the total square footage of your dedicated home office space. I think it sounds like $5 a square foot. Mm-hmm. Or you can take the actual, which then you take your utilities, your mortgage interest, your property taxes, any other general home expenses that are included in this home office, times the percentage of home office expense over the total square footage of your home. Smaller house typically gets a better tax deduction. We have some clients that have like a 6,000 square foot house and they've got 150 square foot home office. It's like, oh, it's not going to be a great tax deduction because it's such a small percentage of your total home square footage. But you can absolutely deduct a home office expense. I wouldn't stress that at all. What do you think, Russell?
Yeah, absolutely. If you've got a bona fide business, right? Like take all of just like we're talking about here with getting paid in cash, right? Like it opens the door for a lot of tax planning, a lot of tax deductions. And so if you can deduct it, then deduct it. Like you, right? If somebody has in the kind of rise of the gig economy, then we people work out of their home. They got a computer set up in there. They got a desk. It's got to be a bona fide office space, right? You got to have a door usually, right? That's kind of part of it. It's got to be a separate space. It can't be your table in the dining room, right? Like we can't be doing that sort of thing.
Yeah.
Can't take your whole house, right? Like your whole house. Just because you look at your laptop while you're in bed doesn't mean that that's part of your home office, right? So there's some limitations to this, right? So be reasonable, but absolutely take advantage of the home office deduction. You're using it for business, and just because your business is small doesn't mean that you have any less right to business deductions.
Right. All right. Number 17. Do I have to pay taxes when I sell my house? What's the rule, Russell?
Yeah, so you get a $250,000 exclusion for your primary residence, right? So as long as you live there for 2 out of the last 5 years, and there's a couple of other little nuances there, but for general purposes, it's $250,000 per person. So if you're married, it's $500,000. So this doesn't mean that if you sell your house for $600,000, you're going to owe tax on $100,000. It means that you bought your house for $300,000, sold it for $600,000, and if you're married, you have a $500,000 exclusion. That's $1,000 gain, $500,000 exclusion, no taxes owed, right? So for most people, most situations, you're not going to owe any tax unless you live there for a very long time or you've seen some enormous appreciation in values. You're going to be safe, right? So most people, when you sell your primary residence, no taxes owed.
Got it. Cool. Easy enough.
Yeah. So can I deduct mortgage interest or property taxes anymore? Well, this is great because we've got a new law coming up, right? So
Right.
What's going to happen there?
It depends. It depends on if you're itemizing or if you're taking the standard deduction. So that there's two different methodologies to taking your itemized deduction. So the standard deduction has been increased significantly over the past few years. So most people are just taking the standard deduction. But if your total itemized deductions, including your mortgage interest, property taxes, charitable contributions, and potentially medical expenses that exceed 7.5% of your AGI, if that bundle of expenses exceeds the standard deduction, then you can itemize and take those itemized deductions. Keep in mind there's limitations on pretty much all those expenses. So medical expenses have to exceed 7.5% of your AGI. Mortgage interest is capped on the first $750,000 of debt. Property taxes are capped at $10,000, and that's property taxes and SALT, state and local taxes are capped at $10,000. Charitable contributions are capped at 50% of your AGI, and that's it. So if your itemized deductions exceed your standard deduction, then we itemize. Otherwise, you take the standard deduction.
There
right?
you go.
Yep. Any answer that right?
Yeah, I think so. I think the thing to watch is this new law. If you got a lot of property taxes, you want to keep an eye on this new law coming up, right? Because of that SALT deduction limitation. So hopefully that gets it passed, it gets increased. You don't have to worry about it, and you're great. So in Texas, we've seen massive appreciation in home prices over the last, especially like 10 years ago, like massive appreciation since then, especially even over the last 6 years or so since COVID. And so a lot of times our property taxes have actually gotten capped at this SALT tax limitation, which is very unfortunate, where we feel like we're in a low tax state, and sometimes it doesn't feel that way. But hopefully the way that they restructure this law will help a lot of folks out.
Yep. Well, here's one that's kind of related to it. Number 19, should I take the standard deduction or itemize?
Yes, just wherever the math works, right? So every year you calculate it and you just see whichever one's better, right? So it's the larger number of the two, and it can flip flop year to year to year to year, right? So it doesn't have to be the same. So it's just a matter of whichever one is best. So what's the best way to track business expenses if I'm self-employed?
Ooh, this is a good question.
I want to see your receipts, Brett.
Yeah, yeah. Keep your receipts. You want to segregate your business activity in a separate bank accounts. All of your in a separate bank account, separate credit card, if you use credit cards, really segregate all that activity, and then we can pull all that information at the end of the year, and we already know that this is all business activity. If you kind of are commingling stuff, it makes it really messy, and then you have to go by line at the end of the year. Definitely keep receipts. And segregate as much as possible. Open a separate business bank account, separate business credit card. Make it easy, and then we can just pull that information at the end of the year. Or if you have enough activity, we could set you up in QuickBooks Online, and we can pull that activity, code it, create financial statements, and it's super easy.
Another benefit of keeping things separate is that your CPA will probably charge you less to do your tax return. So you've got everything commingled, and it takes forever to sort out like what is personal, what is business. Then you're probably going to get charged a few more fees.
All right, here we go. Can I claim the child tax credit if I am divorced?
Ooh. So usually there's in the divorce decree, if you've got a good attorney, you're going to have a divorce decree. It's going to list out like who can claim which children for which years. So sometimes if you have multiple children, you'll each claim maybe one each or two each, that sort of thing. Or one will claim all of them all the time. Now the IRS takes the position of this is a civil matter and nothing to do with us. And so whoever files first wins from the IRS perspective. Now, you can always go back to court and be like, hey, judge, they weren't supposed to claim this kid and they did, that sort of thing. But that's going to cost you a lot more than the child tax credit. And so
File fast.
Yeah, file fast, man. So January 20th, right? You're first in line. And I have some clients that are in that situation, right, where they've got some kind of deadbeat exes, and they've got to get their stuff filed before anybody else. It happens to be a time that we're not really that busy that early in the season, so I'm always happy to oblige. before I didn't know this until I was in practice on my own, right? So working for a larger firm, we just didn't deal with this sort of thing. I remember the first time somebody told me about this, I was like, that can't be right. It is right. IRS is whoever files first, right? And they're just staying out of that mess, right? So
Right. Yeah. They don't want to get involved.
no, want to get that at all. So just keep that in mind, right? So if you have an ex where you've got a kind of a contentious relationship, be sure and try to set yourself up so you can file early to make sure you don't have any problems, but also make sure that divorce decree is super clear on who gets to file who. What happens if I miss the tax deadline? So these definitely aren't clients of yours, Brett, because that wouldn't happen.
You go straight to jail.
Straight to jail. Orange jumpsuit, right?
That's right. Jail time. No, so if you miss the tax deadline, you just want to file as quickly as possible. If you're overpaid, then it's not a problem. If you owe, you're probably going to get hit with some penalties and interest. The IRS, if you have a good history of paying timely, the IRS may waive penalties, but they're not going to waive the interest. You just want to file as quickly as possible. And sometimes we'll have clients that come in that say, hey, I got things happened. I'm 3 or 4 years behind on filing taxes, or 10 years behind.
Yeah.
And you say, well, shoot, all right, let's get you caught up and let's get these filed. Because if you never file a tax return, the statute of limitations never starts. Technically, the IRS could go back, claim penalties and interest, and really, it could get pretty nasty. So you want to make sure that you get those filed and set up as quickly as possible. So next question, do I really need to make estimated tax payments? Russell, what do you think? Do I need to make these things? I don't want to make these.
To, right? The IRS just charge you penalties. Right? No, so here's the advice I give my clients, especially if you're a business owner. At PaySafe, you can calculate an estimated tax calculation every quarter, right? I'd love to do that for you. If you like to have estimated tax calculations calculated every quarter and you love paying those fees, then you should be my client for sure. Let's say you don't want to pay a CPA to calculate what your estimated tax payment should be because you don't know. Pay the safe harbor for the first couple of quarters every year. For most people, that's 110% of the tax due from last year, but your CPA should be able to tell you that at the time that they file, what your 1 and Q2 tax payments, Q1 and Q2 being quarter 1, quarter 2 of the year, tax payments should be, and you can make those payments and then do one estimated tax payment, kind of our calculation in July or August. It's a great time to calculate an estimated tax calculation. CPAs are usually a little less busy at that point. I tell my clients all the time that look, tax prep happens in the spring and tax planning happens in the summer, right? So we've got the time and space to think about it. We don't have 300 emails every day that we have to sort through and respond to and that sort of thing. So we can really think about your situation a little bit deeper, a little bit slower pace, and figure out if there's anything that we can do. It also gives you enough time to make any moves that are necessary. So let's say that you could put a whole bunch of money into a traditional IRA, right? Well, it gives us time to figure out what that number is, that amount is, and gives you time to make those payments in order to capture those tax benefits. Self-employed folks, SEPs and solo 401ks, you can set those things up and get the money in those accounts before the end of the year. So the summertime's a great time to do it. Most people, you're fine. Make a safe harbor payment for Q1, Q2. Do the estimated tax calculation in July or August. Tack on some tax planning to that as well. And then you're ready to go for the next 2 payments of Q3 and Q4. And then after that, you're ready to make, just do your tax return. And at that point, you're not going to owe anything if your CPA is, a decent CPA. If they can do math well, then you're not going to owe anything. You'll be fine. But that's kind of the tempo that I kind of advise for my clients. Do you advise anything different, Brett?
No, I think you're exactly right. I think, if you want to use some tax planning, let's do it over the summer. Yeah, it's always hard when a client comes in March and wants to sit down and really map out a plan, and you're like, this is not the time.
This is not the time. Yeah. You're sitting in a meeting and you get 4 phone calls in the 30-minute meeting or something like that, right? Like this is not a great time for this conversation.
It's like, this is not the time to do this, but
yeah.
Yeah, summer's the time to plan for sure.
All right, last question, guys. And Brett, you get the last question here. How long should I keep my tax returns and records?
Usually recommend 5 years. The IRS statute of limitations is 3 years, but I always like having a couple back years just in case you want to calculate. You want to make sure you can show carryovers and show anything that could impact future years. Kind of the good rule of thumb is 5 years. Anything after that, I would destroy. But yeah, the statute of limitations is 3 years from the date you file that tax return. But if you were to amend a tax return, it starts that statute over. So kind of keep that in mind as well. So you could have prior years that are still open to IRS audit because of a prior amendment. That's why I tell our clients we don't want to amend a tax return unless it really makes financial sense, because we don't want to extend that statute of limitations.
That's exactly right.
Yeah.
I've had some clients be like, hey, I'm going to get $1,000 refund, and you're like, these are, reasonably high net income folks. You're like, this is not worth it. They're like, I don't want the IRS to have any more money. I understand. But, this is one of these kind of pain pills we're going to have to swallow. Right. So we've got to,
right.
We don't want to open up these tax years for another 3 years.
Right. Yeah, and they may save $1,000, but they're gonna have to pay you $500 to amend
Yeah,
it.
exactly. And it's just this idea of it not wanting the IRS to have any more money than they're due, and I totally get it. I understand it. I love that mentality, but
right.
Let's also be strategic about it as well.
Yeah, absolutely. Well, cool, man. That was the speed round of tax questions for asking. We got through 25 questions, man. That's hardcore. We get these questions a lot. Usually it's when someone submits a question, which I love. Please submit your questions through our website at askacpa.co or down in the description in one of these videos. But a lot of times it's like, my mom did this and my dad did this and then this. It's like, the whole story. I mean, there's always so much behind it. And then it ends up like, the question at the end of the day is, should I do a 15 or 30-year mortgage? It's like, that's a simple question, but I had to read, 500 words to get to that question. Or should I itemize? Well, okay, yeah, but it's great. We appreciate everybody that submits questions. Please continue to do so. We typically will respond to those separately and send you an answer to your question, and then if it makes sense and we think it's helpful to everybody else, we will pinch out the portion that we think is applicable to most viewers and bring them up either in videos like this where we can go through a bunch of questions, or if it's a great question, we'll segregate those and answer those in our podcast.
That's right.
This is a good one. This is a long one, Russell. We're up to 52 minutes.
I think it's the longest one ever.
I know, that's a good one.
Well, we took a little bit of a break right there in the busy season, so
yeah.
Thank you guys for sticking with us through the break, and hopefully we've caught you up here on all of your tax questions so far.
Absolutely. Hit that if you're still watching this video. You're 53 minutes in. We appreciate it. Hit that subscribe button. Hit the like button. Leave us a comment down below, and we'll see you guys in the next video for Ask a CPA.
Yeah, that's right. AskACPA.co, guys. Be sure to check us out and share it with your friends. We'll talk soon, Brad.
Absolutely. Thanks, Russell. See you, buddy.